Sanjay Sethi with us. Sanjay, thanks so much for being with us. Firstly, profits have been flat despite the recent corporate tax cut. Talk to us about what has led to that. And meanwhile, sales have grown 12%. So, what's driving revenues?
Well, good morning. Thank you for having me on the channel. I just want to sort of give you a quick overview on the last 3 or 4 months, what's happened at Chalet. We've had a very exciting 3 or 4 months. We've had a robust performance. I think the operating performance has been stellar. We've had new brand signings. We signed 1,500 rooms with Marriott, another 260 with Hyatt, and we've had an acquisition in the last couple of weeks or so. So overall, all in all, a very exciting quarter. Now, coming back to your specific question, revenues, as you said, have been very strong. Now, if we were to actually go back to the EBITDA margins, and I think you're referring to a slide where we talk about EBITDA margins sliding from 47% to 42%. I want to clarify one thing there. Last year, there was an exchange gain benefit of 24 crores. And if you were to adjust for that, for last year, the EBITDA margin last year was 39%. So we don't have a drop actually. We have a gain. And this, you must remember that the exchange gain is to a large extent notional. It's to be entered in the books of accounts as per the new guidelines, accounting guidelines. But genuinely, the EBITDA margin last year was 39%, which was a very healthy EBITDA margin. And we've grown from 39% to 41.8%, which is almost 42%. That's a 300 basis point improvement in the EBITDA margin. So our EBITDA margin has actually been very healthy.
Okay. Has the economic slowdown and weak consumer sentiment dented margins, and do you see that continuing?
So I want to repeat, margins have not been dented. Margins have actually improved. As far as the economic slowdown is concerned, we did see some impact of it in quarter 1, 2 of this year. We've seen a very robust quarter in Q3. The good thing about that quarter is that the 10% RevPAR growth, almost all of it has come out of rate growth, which is the right path to follow. And if we can sustain rate growth, the flow through is very strong of that, and that's what's resulting in healthy EBITDA margins actually for us. So if you look at the hospitality EBITDA numbers actually for the year, our hospitality segment EBITDA has grown from 38% last year to 39.8%, almost 40%. That's 200 basis point improvement in just the hospitality division. And the rest of the EBITDA improvement has actually come out of the office and retail, because we had the large office in Sahar getting occupied and throw up rentals.
The rental and commercial revenue, that's been growing at a hectic pace. What's led to this kind of growth amidst this slowdown? And do you really see this momentum continue going forward as well?
So what happens in rentals is that when you commission an asset, there will be a jump in rental growths, because we commissioned the large office building at the Mumbai airport location, and that got occupied by our tenants over the last 2 or 3 months. Right now, the occupancy is close to 90% occupancy. It's a single group entity that's the tenant there. It's a long lease, so there's no risk to that lease. In addition to that, we activated the Orb, which is an F&B hub, at the same location, which is also the location of the JW Marriott at the airport. And all these 3 assets become complementary assets to each other and drive businesses to each of them. So yes, rental growth has seen a spike. It will see some more spike as we fill out the Orb over the next few months, and then it will stabilize. After that, we've got 1 new office building that is going to get commissioned end of this year, or end of this calendar year rather, in Bangalore, which again will see should result in a spike on rental income. And then the year after that, we have this massive office building coming up at Powai, which will get commissioned sometime in 2022, which is a very large building. It's almost 7.5 lakh square foot of leasable space. So rental income will grow as we build new assets, and it will grow in spurts and then stabilize after that, because we have an annual increase in that. The hotel income is the one that's going to grow as per market trends, and we expect that to continue to grow pretty robustly. You must remember 88% of the revenue comes from the hospitality division for the company.
So Wanted to talk about your occupancy levels because that's also grown. What has been the performance city-wise? If you could break it down for us.
Certainly. So Mumbai region, which has majority of hotels, 2/3 of the inventory is actually in this city for us, has grown from 75.8% to 76.5%, so about 70 basis points up there. Bangalore's grown by 40 basis points, Hyderabad by 100 basis points, and the portfolio overall has grown by 70 basis points.
And what about?
So as I said, the large amount of growth has actually come from the average room rate.
And do you really see the ARRs, going up forward? And what really is the outlook that you foresee for ARRs?
So look, the macro dynamics of the industry hasn't changed. It continues to be favorable towards demand, which is growing at a faster pace than supply. Supply continues to be muted with the current liquidity crunch and the market conditions. We see that supply probably going down further. Whether it goes down or not, demand continues to outpace it, even in this challenging environment. And therefore, occupancies will continue to grow. And as rooms or days get filled out, we see an aggressive growth in rates. And that sort of panned out in the October to December quarter.
All right, so that's on the ARRs as well. Okay, what about F&B revenues, costs? Is this pie growing? Sanjay, talk to us about which are the segments that you're focusing on.
So look, roughly 33% of our revenue comes from food and beverage. We haven't grown as aggressively on that segment as we would hope to. And the primary reason is that the banquet sales in Mumbai hasn't done as well as we expected it to. So JW Marriott Sahar and the Renaissance in Powai, which have a heavy base of banqueting business, almost 60-70 crores each on a year, hasn't seen the growth that should have happened. It's driven by 2-3 factors. We've seen discretionary spends on large commitments going down, and therefore a lot of the large conferences and events have either been scaled down or been deferred. We've seen wedding business slowing down a little bit. But having said that, the restaurants have actually overperformed. So restaurants have done very well, bars have done well. The challenge has been on the banquet side. But this is typically for Bombay. In Hyderabad and Bangalore, we've actually seen 12 and 14% growth respectively in food and beverage there. The Navi Mumbai hotel has shown about 7% revenue growth in F&B. On the cost side, we've kept them tight. Our overall costs have grown at 5% in spite of the revenues growing at 7 to 8%, and therefore our margins continue to improve.
Okay, any other non-hotel assets, particularly commercial or retail assets and some of the land parcels that you're working on? What are the development costs like at the moment?
So we've got a few hotels in the pipeline. We've spoken about them earlier. One is the Hyderabad hotel, which is on schedule as per plan, scheduled to open in Q2 of next year. It should be finished by end of Q1 next year, and we should be able to commission it and open it to guests by Q2. That's a 170-room Westin that's opening there. We've got a hotel in Airoli, which we signed with Hyatt Regency, which we start work on sometime next month. And once that gets so we start work on it, we should finish that in about 28 to 30 months' time. And finally, we've got a W hotel in Powai, which we should start work sometime in 3 or 4 months from now. The other thing that I do want to talk about is the acquisition. We did acquire the Novotel Pune about a week and a half back, though it is in this quarter and not the previous quarter, but it's in public domain now. That's a 223 operating room hotel, and 88 new rooms can be added to that. So the acquisition is actually for 311 rooms. And that hotel came into Chalet fold on 7th of February, exactly a year from listing of the company.
Thank you for joining us today, Sanjay, and patiently taking us through all of those numbers. Good chatting with you.